All right. Nice week. Hope everybody's got some nice weekend plans. Um, we ended this week with expected July chop and sideways movement and a lot of confusion about market direction. Did have a rally on some probably bogus Moderna news on Tuesday, and I didn't. We never really moved past down um, that close on Tuesday on the July 14th in most indices. Even Dow Jones had a problem coming back to retracing that gap. So I expect more tricks and more vaccine news until a vaccine is actually produced. Um, all the way, it could be all the way till the end of this year or early next year, and they're going to keep playing games and keep finding ways to save the market at the most. Um, I don't like to use the word manipulated, but after seeing that instance a few weeks ago or months ago, where GDP data was supposed to be released at 8:30 in the morning Eastern time, and in place of that GDP data, um, vaccine headline news is released at exactly 8:30 a.m. Eastern time, and the GDP data itself was delayed by 90 seconds, which never happens. You never see something like that delayed, and you have to wonder, what were they doing? There's not some guy that has a piece of paper running down the hall that has the GDP numbers that he has to type into a computer and then press enter so that it can be published worldwide. They know the information 18 hours in advance. So that to me was very interesting. And then this Moderna news, which was announced at 5:01 p.m. Eastern time on Tuesday, 1 minute after futures closed for an hour. So they did it on purpose to create this gap, and the gap in the futures for that 1 hour close. And I find that somewhat manipulative. I want to I try to shy away from that because I don't like to say things like market rigged and what a scam and all those kind of things, because that just deters from people actually trading the stock market. It is what it is. The stock market is what it is. The headlines are what they are, and the games are what they are. So it's just our job to profit off of them. So I kind of shy away from complaining about it too much. But those two instances were probably one of the most obvious examples of what you could call manipulation of the markets. But what I will say is that dark pools and other big players in the game, and dark pool volume makes up 40% of the volume now in the stock market on the various 50 something dark pool exchanges. They already made their bets in advance, and they probably said, go tell your buddies to release this news event and then push the stock market up. They weren't short during that time, they were long, trying to capture that move. So the headlines are just used to push their bets into profit. And that's kind of what we have to remember. So what I have in the background are Dow Jones futures, and I've got this in this weekly chart. I've got this big channel that goes back to the 2007 Great Financial Crisis high and the bottom in 2009, and I've got it as a parallel channel here, showing that we kind of had a double tap up here, and I kind of just used that same line to go down here, and we had a bottom here in early January. So we're traveling in this parallel channel here, and we got saved right there. On a log chart, it looks a little bit different. If I hide all of these drawings, oh man, not all of them, just some of them. If I take out some of these guys, all this stuff, you can kind of see that even in a log chart, we kind of held here in 2019, and then broke through convincingly, very convincingly, to the 2015 high top and then have back tested this trend line. So we've had some trouble on this trend line, and I think that we will continue to see that as we try to go up higher. However, um, I remain bullish on the stock market because it's showing us that it's willing to go up farther than people think it can go up because of all the Fed intervention money. And it looks like back this trend line also for Dow Jones futures, if you connect the 2018 high with the, January and October 2018 high, you get this trend line here that we've been kind of hitting. We hit it in 2019 in July, and then almost hit it right here again in June on the June FOMC. So I'm looking at these things, and these are the kind of plots that I'm looking at on Dow Jones futures to kind of understand where all the resistance levels are. So today's close and the aftermarket selling that we had after hours in the last 15 minutes, not great. This price pattern hitting this dotted trend line that we connect these two high points here, and the way that the candle structure is with a low coming in after this candle right here, after the Moderna news gap up, and then the way that we're closing here, we could come back down to the 200-day moving average in yellow, maybe even further. I don't know. I tend to not believe that this is an actual Gartley top pattern. I am more conditioned to believe that this is some kind of a impulse wave going higher to a higher level. And the idea that I have on this is this seasonal long into August for election years. And I just kind of guessed at what this would look like. And we've actually, if I press the play button, we've actually performed this price pattern that I just kind of, guessed at what the price would actually do going up. So this was just a lucky guess on my part. It could fade, it could completely diverge starting next week, but so far this is kind of what we're doing. And this pattern, if it holds out, this big swooping up pattern, a capitulation top where retail killed the market that I talked about a few times in past webinars, and then this move down, a consolidation, and then a huge swoop up. This is and it's a big breakout pattern. That this is some kind of a right shoulder pattern for a big head and shoulders pattern, and this is actually the right shoulder and then the big breakout. So I'm still leaning towards that, but this price action was not very constructive today. If we go much lower, we're in trouble. S&P 500 futures actually passed the same trend line in white here, and we've got all of the important moving averages running in a direction that is very positive for S&P 500 futures. You have the 200-day moving average, and we had a golden cross a couple of days ago. The 50-week moving average, which is kind of just running with the 200-day moving average. The 21 EMA, which is offering support here, sort of here. Not so much here, but definitely at these couple of points here. And we've broken through. We did not fill this gap, the Moderna gap. It is still an open gap on July 14th. It did not come all the way down there. Only Dow Jones and Russell 2000 futures have filled that gap in USA session hours. So it's possible that we need to actually come back down here, fill this gap before going higher. And that would also be a back test of this broken white trend line and a back test of the month Camarilla R3, which is part of that type 2 Camarilla trade that I talk about. We didn't quite get to the R4, but that's okay. We can still back test it. So this trend line will probably offer support. And if we can get a 21 EMA hit at the same time, I imagine that we can go higher to this R4, and then the ultimate target is still this February 21 gap zone up here. This is February 21 back here. Then the next day, that was a Friday, and then February 24th. This is a nice target, and I bought September calls right around here, and that was a great trade to hold all the way through this. I wanted to give it plenty of time to actually unfold because July is a really tricky month. Dow Jones futures, or Dow Jones index actually, for election years is what I've been looking at over and over again. Once we started kind of realigning with it in May, that we had a big, well, we didn't have a big bottom, but it was definitely a starting point for a big rally into the retail capitulation rally, which is shown in gray in the background here. This is fitted in order to see the peaks and valleys of the seasonal profile, which is in yellow. Back here, it started off actually a little bit early, but that's okay. And then retail really killed the rally here. Right here, this sequence right here that happened in early June into the FOMC, this FOMC date right here, that was, Norwegian Cruise Lines, Carnival Cruise Lines, Rig, Hertz, everything that are bankrupt companies getting bid, and they made a parabolic movement that got killed, and then that generated this island top in the market during this time. And just this week, we managed to actually fill that gap in S&P 500 for the gap that actually was created there. So it's no longer an island top. We filled that gap right around here. So this is not considered a true island top anymore, even though it did work for a little while. This is really ugly when something like this happens. But we did fill this gap and kind of have rejected it so far. So if election year seasonality holds true, we're still waiting for this July FOMC to possibly get in a big long trade into September. And then right here is a great time to just go 100% cash and take a month off of trading the stock market, or just do scalps along the way and use some other short-term trend trading strategy. I will not hold anything probably long or short during this time because you just don't know. You could just keep plowing ahead before the election, but I kind of doubt it. There's a huge amount of volatility built into the October VIX futures contract, so I suspect that we do indeed have this kind of a sell-off. So I did a Twitter post. Oops. A couple days ago. And if you search for it, there's this picture that I posted that is showing what I think Russell 2000 was going to do over the next couple of days. I am a big fan of using these Donchian channels, but I use the close price, not the highest high and highest lows, and I use 21 and 55. And in this particular case, Russell 2000 has traveled in this parallel white trend line ever since the bottom. It's had hits on the top twice, rejected both times, and each time the bottom is hit, it acts as support. Tried to dive out of here, but the 50-day moving average saved the day and ejected us with that Moderna news back in, and actually finally managed to close above the 200-day moving average, which was a failure back here in mid-June. Every single time we have hit this 21-day highest close and ticked it higher is the key. It's triggered a big rally that's on average about 6%. You've got maybe 7, and then 4, and then maybe something like 6% over here or something like that. So we've kind of paused in this area, but not too bad. So if we look at what it currently looks like, we have had an inside candle this past day, and still, let's see, if we closed above the 200-day moving average again, which would be constructive. What did it say? 1466, we're at 1469. So there's still 30 minutes to go before futures close for the weekend. But this is constructive, and I like that it's an inside candle compared to yesterday's bearish candle, or this white or red candle, whatever your coloring spectrum is. My immediate target is up to this R4. That would be in line with these previous three moves. And perhaps at that point, when it gets up to here, this would actually be some kind of a bearish divergence compared to this previous high. And then maybe we can have a sell-off. I don't know. I just continue to go with the seasonality. I continue to go with the Fed. The Fed is continuing to buy. And if we go to, I've got these things bookmarked. So if you overlay the S&P 500 over something like this, this is the end of QE1, this is the end of QE2, and then you have the big QE3, and then here's repo, and then here is QE4 started. And I have this overlaid on this chart. Thanks to Ari in the group for actually making this. I was going to make something like this myself, but this is a great tool, and I really appreciate the work done here. And if I drag this onto my S&P 500 chart here, or my S&P 500 futures chart, takes a second to load. So what we have in the background, and if I hide all of these EMAs, hide all of this stuff, you can actually see that from 2008, here's the financial crisis, here's the 2009 bottom, here we are today. You can see that the Fed buying in either U.S. Treasuries or mortgage-backed securities, and if you combine both of them, it gives you a better view. But somewhere around the peak, and one of them offers, a selling opportunity. This was a big one for mortgage-backed securities. Right around where this topped was a big top in 2010. And then right around where U.S. Treasury purchases by the Fed topped in 2011, there was another 20% correction right when this tapered out. They were front-running it, knowing that this was going to end. Went flat. Here's Operation Twist around there. Here's the start of the next big bond buying program. You can see that it just runs right in parallel with the bond buying program. So if anybody tells you that there was another reason for the stock market to rally from 2009 to 2016, they don't know what they're talking about, because people that are in the trading community know all about this. And this is the only reason the stock market really went up during those years. It should have just gone sideways, but the Fed intervened and created the bubble. After this QE3 ended, it took some time, because of the length and duration of it, for the stock market to eventually do some kind of correction in 2015. And then we got a rally into the election, which is right here. And this is the first time that the stock market actually rallied with no Fed intervention, and rallied all the way up until, and then interest rates started to increase, right up until the Fed said, oh, look, the market's rallying and the dollar's going up, and interest rates are not having to decrease, and we're not having to buy more bonds or MBS. They started to unwind this balance sheet and sell $30 billion a month, and that triggered this big capitulation move, which is this nice big what I call an S wave that started probably at the first part of the election, like this. And then there's a middle section. And then a final capitulation. It kind of matches the first impulse move from when the election actually happened, and then matches it up here. This is where Bitcoin failed, and then gets killed on the other side. This is also another one. I've talked about this many times. Into repo. This is another big one. Talk about this often and then get killed on the other side. So I like using these because they definitely show you where the market could possibly capitulate. So the reason why I give this backstory is because if you look at today, where QE Infinity started right at the bottom with MBS purchases, the U.S. Treasury never really stopped because we started repo in October, September, and then the Fed kicked it into overdrive with more bond buying, and we have never stopped increasing for both of these, really. I mean, this took some breaks a little bit, but cumulatively, we've never stopped increasing. So, knowing this, there has never been a time where the stock market has ever had a top without one of these topping. And so far, that has not happened, which is one of the reasons why I cannot go against the Fed at this point. Once they created the bottom and once they let the market realize that the Fed was going to intervene at all costs, I can't really expect anything other than a continued rally in the stock market. This week's weekly candle is extremely constructive towards going into maybe some sideways action next week and then possibly a rally into the FOMC week, which is what we are waiting for according to seasonality. We did break the previous high, though. If I look at Dow Jones Transports, this is the 200-day moving average. And we're just underneath the 200-week moving average. So we are getting somewhat of a rally in transports, managed to close above the 200-day moving average twice. I don't know if this is going to be a bearish correction after this. There's still a lot of work to do to go higher. Much more work. Emerging markets, much more constructive. And this is something that you need in a true rally. And one of the reasons why the dollar is actually decreasing. Money is going into other emerging economies and the Chinese yuan, instead of the dollar, and the dollar is falling off. I did an idea a couple weeks ago where I said that the euro and the dollar could possibly repeat the 2009 sequence. The first sequence, this is 2008-9, the reset, dollar buyback, some big correction, last chance to short in mid-June, and then a gradual decline all the way to December, November. So far, this is the same kind of a movement. Bottom on year Camarilla S3. This is the reset where all assets are sold. Dollar buyback. Zigzag type correction. Last opportunity to short right here in mid-June. And then decline the rest of the year. So far, this has actually worked out very well for the euro. And we are actually doing this movement. So my next target would definitely be year Camarilla R4 up here at 1.16. But if we're going to repeat something like this, it's going to take time. So this is definitely playing out. And the British pound idea that was the counter to that idea was not playing out. But for some of that, I was hedged with a Euro GBP long in order to counter that. So this is very constructive for emerging markets to continue higher. We're now above the 200-day moving average, the 200-week moving average, and the 50-day moving average is sloping up in a nice way. So more consolidation is probably needed before we go higher. GDX, along with gold, did this consolidation move and this big drop earlier in the week, which was a buyback opportunity that we definitely took advantage of in the gold space. But we broke this trend line that has taken a couple of about a week or two to develop. So we broke above this convincingly. This is a great breakout. Maybe get a retest back here. You don't know. You really don't know. But the next target's probably this month, Camarilla R4. And this is a convincing breakout inside of this somewhat channel that I'm guessing at that we're actually building. So back in 2009, GDX more than doubled, and the rally lasted for 1 to 2 years, and that's exactly what we're getting since the bottom in March. The bottom in March was way back here, and we have doubled at least since then. So this can definitely go on for longer than people actually think. Miners are one of the best things that you could have bought at the bottom. You'd have 100% gain about right now. So next stop is probably maybe some consolidation. We might not even get a full retest back here. It might be, somewhere around 38.70, and then at that point I would just say start taking stabs with small longs here to try to get up to the next level. Silver has been doing extremely well, which is what we talked about in the last session, with silver starting to outperform gold. Gold has been just sitting up on this month Camarilla R3 pivot over this entire week, and we had some confluence with the weekly R3 at the same location, so big resistance level. But I imagine that once this is broken, similar to how GDX is actually leading gold, which is always good news, GDX usually leads gold to the downside and to the positive side. So the next target would be this August 2011 close. Still a lot of buyers. Hedge funds are nowhere near long enough to, on the CFTC data, to consider really getting out of gold. And if this is a true reset, like I actually think it is, that we had in March, just like 2003 and just like 2008, where everything got sold, including gold, way down here to this S3 year pivot where I almost got a trade. I should have front ran it just a little bit, but I did not because it was a weird time and stuff was scary. But it went all the way down to this 1450 area. This was the reset. Everything was bought back. Gold was sold back then to cover liabilities because anybody that was holding gold needed to sell gold for cash so that they wouldn't get margin called in their other position. So it was just a cash raising exercise. But once all of that was done, they could get immediately back into gold because nothing changed about gold. There was nothing that changed. So this was a complete sell-off in order to cover liabilities. So we had this big inverse head and shoulders a couple weeks ago. This is where I was buying heavily here and still holding, going in and out along the way, but still holding, and I buy back in over and over again. I've been buying back in, and definitely doing silver also. Bonds have had a great move. There was a huge 500K TLT print about a week or two ago, or last week, and this is when I got back in bonds heavily. The bond seasonality says that we have a major rally into late August with gold, and that's when I'm going to get back in heavily. I still think that we can maybe test this channel again next week before going higher. This is the gold move that I'm anticipating into the FOMC, which is on July 29th. So we're approaching this and supposed to be going sideways, and then the 10-year seasonality shows that on average we have a big rally into the end of August. The same thing happens for 30-year bonds. And people think that 30-year bonds just can't go any higher and interest rates just can't go any lower, but the Fed is on a bond buying program, so I completely disagree with that argument. Next couple of days, possibly some more buying, but you remember, this is just a guide. It's not exact. So some years it's, floating around certain dates. So you kind of have to use a little bit of an art form and some technical analysis to hit this. But going into the FOMC, or possibly this bottom right here, is actually on average the FOMC date. Just like how we had to deal with the June FOMC date, we guessed that the major top that showed itself around that area was likely because of the FOMC, and the FOMC is a floating date in June for the quarterly FOMC, probably in the range of 10 days it's floating. So it's floating around a 10-day range date is what we're thinking. So it's possible this bottom here on July 24th actually is the FOMC and they're selling into it. And then a big rally, the biggest rally of the year in bonds. And then after that, it's not really that great holding bonds in your portfolio unless you're doing a minimal one for protection just in case. SPY has continued to be bounded by these two very large dark pool levels from the past. One from a huge one from February, right before the Fed did the first emergency intervention, and this one from December. Way back in December, this 40 million dark pool level that's actually grown now, where we got some of those sneaky fuzzy prints that I don't know what they are. I just call them fuzzy blocks because I don't know what they are. They occurred in pre-market above the SPY high and above this pre-market SPY high and well above the SPY high from yesterday as well. So the price never visited there, and it seems like from our strategy, every time we see this, usually the same day, somehow, some way or another, we actually go up and visit those blocks. So in the chat group, I posted those blocks at like 321, 322.22 or something like that. And we finally went up or 11 to 12, finally went up and visited those blocks, but it took all day to get there. That hit happened right around in this area, and then we finally had a chance to reject. There were some big live 1 million print SPY blocks came in at the same time in this area. I started shorting for cover into the weekend and did the same thing on NQ and the same thing on YM also to take advantage of just, protecting myself over the weekend somewhat. So we did close below this level. We have yet to close above this level for any day, except for back here actually on June 8th. But then it was quickly dispatched after the June FOMC, which we shorted in this area. So we're still bounded by these blocks. I used Tableau today and the dark pool API to pull up all of the blocks back to October that are dark pool blocks, and these are all the levels. No time associated with this. The x-axis is total aggregate volume in millions, and on the left is the price. So this is that level right here for 321.8 bin around there. 320. The actual real value is 321.94 to 95, but that's just the bin that it's in. So this level has actually grown to 56 million, and there's a matching one down here at around 297.7, but that corresponds to this guy right here, 297.89. It's just the bin that it's actually putting it in, 20-cent bins. So these two levels are huge. It is possible that early next week we can come down here and backtest this third major level around 319.40 is something that we can actually backtest here. So if we can actually, just bounce inside of this level, these two levels, and then finally go up, that would be extremely bullish to finally break through this level after consolidating under it for several days. This is usually this is what I call a top triangle breakout pattern. And they happen at tops for a continuation kind of. This isn't a very good one. I probably need the pre-market data to actually get it, but the pre-market probably looks like something like this. So this consolidation pattern, if we start breaking above, it's very, very bullish. And the next stop is probably going to be that February 21 gap open on February 24th, the next day, the open of the next day. That would probably be the next likely target up near 3,300. And that's the calls that I have is 3,300 strike on purpose because I was looking at this back here to actually break out and above. So the breakout pattern for ES is much more constructive than Dow Jones futures. Dow Jones futures aren't so great. this is not so great. If we start falling below the 200-day moving average again, and then beneath 26,000, likely have to come all the way back down to the 50-day. Worst case scenario is if this really is a Gartley pattern, and this really is a top, which I still don't think it is, then we would actually come, much further down, maybe to the 200-week moving average. But I'm not going with that because I'm going with the Fed and I'm going with seasonality in election years, and that's actually what my thought process is on all this stuff. So I am actually not in bonds for the first time in many weeks. I was long from here all the way to up here, so about a $7 to $8 gain, which amounts to 7,000 to 8,000 per contract return, because I was going with the seasonality. I was going with that big seasonal low that happens in mid-June in advance of the FOMC, and then a big buyback. So the seasonality stuff is really working this year, and along with the Camarilla pivots is really helpful for bonds and commodities. If we look at copper futures, copper had an explosive recovery throughout the year, or after the big reset. It topped well in advance of the stock market on that first top in January, had a huge sell-off, and then S&P 500 actually from here went up to a new high. If you actually look at it, S&P 500 had this similar top up here, similar sell-off, which I thought was going to be the big one for the big S-wave sell-off, but got fooled by the China bank and got out of my puts, but wish that I held them because they were something like a 3,500% gain if I would have held them all the way to expiration. That was painful, but it's okay. S&P 500 went up to make a new high, but copper clearly showed a huge amount of weakness in that move. And then the next high up here was just a lower high, and then a big capitulation, and S&P 500 caught up in a big way. So this looked like it could have been a big capitulation moment. We went parabolic twice in this rally. Here was the first time into the June FOMC, had a consolidation against the 200 SMA on H1. This was a great place to buy. And then another consolidation right against this 200 SMA on the hour chart that I'm on right now, along with this S3 weekly Camarilla pivot and the weekly pivot as well. So this was a great place to buy, and I started buying right here and then added right on these pivots. That was a great place to buy, and I got in all the way long through to 2.9 when I sold all of this again. So great trade. It's possible that we can have another higher high, something that we go up to this area. Oops. Possibly up to here to finally get this $3 level, which people have been talking about. This $3 level would be really critical if we could actually get there. I don't know if it can happen. We'll see. This would probably trigger a lot of selling, and this might be a bearish divergence where you could see maybe like RSI making a lower high, but the price makes a higher high. I don't know. It could take more consolidation into this channel, and then maybe gradually we could come down to here and then make a really shallow move up to a new high to $3 and then get crushed. Something like this. I don't know. This would be a type 2. Well, the month would probably end by then. Silver has been great. Just great. The pattern that we broke out of, this big trend line here, big one. We did back test it, and I bought some more right here, and that was a great back test. And just to show that the Camarilla pivots really are really helpful, this bottom was right on the year S5, which just to get down there is freaking nuts. Like, it's just crazy to get down that low. We busted through just so much. We busted through 5 year support on that move down. This is a classic Wyckoff down thrust or spring. You burst through a support only to come right back up, and right here would have been the buy with weekly candles. This is an inverse piercing line pattern, and then break through somewhere around here, right above this high of this green candle would have been a buy at 1470, and the rest is history. This is a classic move for a spring Wyckoff up thrust, and now we're breaking through this. So to me, silver is extremely bullish, and the next stop would be around this high, around the $20 level. No problem. If you can see that back here in 2011, where CME raised the COMEX margin rates for silver, they doubled them to use silver, and there was a bunch of other reasons why there was a top here. Lots of room to go. So we might need another back test here. We are on year R3. This is just an incredible range that we've traveled in, almost making a 200% gain from the bottom. So this year R3, I actually think that this is forming some kind of a head and shoulders pattern right here against this resistance, and we might have to actually come back down to the 18.3 to 18.5 level. I don't know. It's possible we can continue higher. Seasonality for silver says that we just keep going higher up until I think September. Yep. Into the FOMC, lots of chop. Silver loves to chop. It loves to wipe out longs with overshoots down. It happened to me last night, and I doubled down on the long and then sold the second contract at my original position to effectively lower my position in only one contract. Silver is dangerous if you haven't traded before. Somewhere around September with gold, there's a big move. So from now until September, well, at least until the FOMC, silver outperforms gold in a big way. One of the really important charts that I've been looking at is the China A50 massive 5-year wedge breakout that we broke out of last week. And this is just gigantic. Or no, 1 or 2 weeks ago. This is a gigantic breakout. And I'm looking for, definitely had a sell-off, and that was a needed sell-off after this huge volume that we had on the breakout and the move up. Definitely think we need some kind of a back test. Somewhere in this area before moving higher. But it goes to show that if China is strong, the dollar is probably going to experience further weakness throughout the year. And their stock market is doing incredibly well, and breaking above the 2015 high is just great. So if you look at A50 futures, because this symbol on Owanda doesn't go back far enough, I have this other chart that just shows that where we are. Oops. I don't know what that's doing. Not these. Where's the other A50? Could be these. Nope, they don't go back far enough either. I think it's definitely these. And I guess the data has been corrupted, or I don't know what's going on with this, but let's see. There's something happening where there's a price way down there. What I wanted to show is that China actually starts out on the A50. It starts out way up here at like 25,000. So we're at highs not seen since 2008 on this particular index. So it goes back. The high that we've reached is super important. It's actually a 12-year high. We haven't been this high in the China A50 in that long. So we did actually backtest this for futures, but not the index. So it's possible we need to come down a little bit more. We did backtest for futures, but not for the CFD index. So that's kind of what I'm looking at into next week. Expecting more chop, expecting more uncertainty. Don't really know what's going to happen. I recommend to everyone to go through that article, that public Rambus article that my dad actually forwarded this to me, but I was a follower of this guy long before people even found out about him in some private gold rooms. And he just does a lot of charts explaining his motivation on what he actually thinks the stock market is probably going to do. And he goes through tons and tons of charts. The guy's name is Rambus, and he actually talks about why he came up with the name Rambus, which is a really interesting story that happened when he was investing in a little chip company back in the dot-com bubble, and made probably a fortune, and used that to start talking about trading stocks. So he goes through a lot of charts that explain why this is a real bullish breakout that you can probably believe in, despite all the bad news. Most of the bad news is actually behind us, and we keep going. We had a 15% quarter beat last year. Last quarter, I'm sorry. And I forwarded that graphic. What happens when we actually beat the last quarter by 15% or more? And usually, let me see if I can actually find this guy. Talked about it a couple of times. Where is this thing at? Let me see if I can find it. I'm going to look for it in the nope. Give me 1 second, see if I can find it in like the Telegram group, and if I can't, then I'm just going to move on. Here we go. Got it. Do an so everybody can actually see this. So if you look at this is an interesting statistic. Quarterly gain greater than 15%. The next quarter has a beat 100% of the time. The next quarter after that has a beat 100% of the time. So we're currently right here looking at our current quarter, and banks so far have been doing great, probably because they lowered the earnings. They lowered the earnings requirement, and now we're beating the earnings. So that could be one thing, but this is something to look at, and this goes back to 1998, and I keep talking about how I think that we are actually repeating 1998 to 2000 with a big euphoric push that is explosive for NASDAQ up to something like 13 or 14,000 is my crazy target. But I'm just going based on the shape of the NDX and what it's actually doing, and that seems like the way where it's actually going to go. Based on the amount of momentum that was required to make this move, it seems like we're repeating something like that with unlimited Fed intervention. So there's a ton of charts on here that are really great analysis moves. So here's one of those, this is NDX, huge capitulation move. Talking about a big parabolic move. Are we doing another parabolic move into the next big cycle that's from maybe 1998 to 2000. I don't know. It's possible. Are we already there? Is it already the capitulation? I don't think so. Not until the Fed bond buying actually ends. So take a look at this article because it's got some really great stuff on, this Amazon chart. If like this will make you a believer. Like something like this is a classic breakout. You got to let the charts speak for themselves. I told people to buy back here when it was like 15,000 or something like that. And now we're at 3,000. So we've over doubled beyond where we actually started at. So take a look at this stuff. It goes through a lot of charts. It goes through gold charts. Goes through tons of stuff. Why you can the FXI. I think this is for China iShares large cap. Like this is a great pattern breakout. And this goes along with China A50 that I just talked about, where you're doing a multi-year breakout pattern that you can actually trust, and that we needed a market reset in order to create this condition. And that's exactly what we got, just like 2003 and just like 2008 Lehman Brothers, and the markets have been going up ever since. And my theory is that by the time we get 1 to 2 years into this, a lot of people are going to be looking at it and saying, why didn't I buy? I kept doubting the market. I kept doubting the rally. And here we are in the future. So that's my prediction. We still have some work to do. There's still some chart weakness that could prevent us from getting there in a smooth way. But I have to trust that, QE while it's going on, and the Fed's promise that they're going to intervene no matter what. And likely July 29th meets with more phrasing that QE is going to continue, and much more aggressive QE because of the coronavirus and because of cases in the United States surpassing all other first world countries in the world, and we're not doing so well. So look for news articles in the next couple of weeks that they could possibly be extending the July 31st pandemic unemployment assistance stimulus, and it could be expanding into the future and into December, which would be right in time for that July 31st FOMC for election year's DJI seasonality. If they announce that there's some kind of an extension of the unemployment right before this FOMC or right after, it would be right in line with this seasonality movement. And then everybody outside of this group would actually think that, oh, that's just a coincidence, stock market manipulation again. But no, there's people that are really smart somewhere that know these seasonal moves and time the news in order to make the move actually happen. And this, you could see the same thing in February and January. January, we already knew about the virus. We already knew about the virus in January up here. We already knew about it here. They waited until February because February is a big crash time for the seasonal time where stock markets can crash, and they waited for it. And then all of a sudden the negative news started pouring in. So there's definitely a concerted effort to release news at really pivotal dates during the year. Okay, so check out that article. It's really it's interesting. I'll post it in the YouTube info section also, just so people can look at it, and probably post a couple of other things. All right, have a great weekend, everybody. I'm short covered over the weekend to protect myself, and we could possibly get some negative headlines over the weekend, and I will likely cover those shorts, or at least put the stop at break even as soon as the Sunday Open happens if they drop down far enough.